Alright everyone, welcome back to another day with Money, Finance, Freedom, your ticket to financial freedom. Today we're going to be giving you 3 dividend stocks to get paid out monthly on a Warren Buffett style trading. Now, we're going to start out with looking at the S&P 500 ETF Trust, SPY. As we know, Warren Buffett is a huge fan of this index fund, this ETF. The reason being is because it has tremendous growth with relatively low risk. And if you're a beginner, he says get into it. Might as well get that 7 to 14% back than leaving it in your bank. It's the best way to get started in the market and grow your money. But today we're going to be focusing on those dividend stocks, the stocks that actually pay you to buy them. So those stocks today are going to be Coca-Cola, Pepsi, and Starbucks. And I want to get into each one and tell you why they each have their own individual reasons for buying, or potentially their own reasons for backing off and waiting for a better buy point. We're going to start with Coca-Cola though. Coca-Cola actually has a fantastic trend line right now if you're looking to buy. If we look at the Coca-Cola stock, this is Warren Buffett's favorite stock. The reason being is he knows that Coca-Cola gets used every day. They have a very stable stock and they pay a huge dividend of 3.35%. Now let's take a quick look at their charts before we go over to Yahoo Finance, because I want to show you a little bit about the data behind that stock. We're going to look at the last 120 days, and what we're going to see is steady growth, some large fall-offs, with some market returns afterwards. So we're going to see this kind of M pattern in the large shoot up, and we just saw a huge sell-off of Coca-Cola recently. Now, their numbers are okay. Everything's going decently well with Coca-Cola as a foundational company. Remember, they are a blue chip stock. Now, understanding how strong of a company they are, we're going to go ahead and take a look at our market visualization of the consumer staples graph here. So the nice thing about this visualization is it shows you based on color heat map. Now, overall, if a stock has gone up by a lot or down by a lot, it's going to show up in different colors, brightnesses, and overall dimension. We're going to see that Walmart and Procter & Gamble are on here, but we also have Coca-Cola and Pepsi. These are actually 2 of the stocks we're talking about today. So we're focusing actually on all 3 of these stocks being beverage-oriented stocks because they're things that we use every day. Back to the Warren Buffett methodology, he always says invest in things that you know and things that you use every day. And these are 2 great examples. Followed by that are actually Walmart and Procter & Gamble. Both of them also pay a dividend. We'll do another video on those. But today we're focusing on the beverage companies that pay us a fantastic dividend. Coca-Cola and Pepsi are huge competitors and they take up a big part of this market, which means they're a relatively safe play. When we're looking into investing in a dividend stock, we want to focus on the market cap that they have, the overall dividend payout, and how much of their profits they're paying out as well. Coca-Cola pays out 86% of their profits. Now this can be a little bit concerning for some because a lot of investors want to see their companies put the money back in, diversify and expand, but Coca-Cola doesn't need to do this. They can't be like McDonald's and go buy more locations. They don't want to come out with a bunch of new products, so there's not much that they can do. They really spend most of their money on advertisements. And since they make billions of dollars a year, that extra 20% that they have left over, it's actually only about 14% that they have left over, is spent primarily on advertisements as well as keeping the company up and running in general, so their overhead costs. We're going to take a quick look at the Yahoo Finance page of Coca-Cola, and we're going to see that they have relatively good volume at 17 million as an average, but right now we're down at 10 million. So it's trading really low, and for good reason. It's because it's selling off, it's not performing well. Their earnings weren't fantastic, but that's okay. We still have a 1-year target of about $57, and that's conservative for Yahoo Finance. We see a downtrend. I see this as a buy point. Buy the dip, buy it while it's on sale. Coca-Cola is going to be around for a long time. Next, we're going to go ahead and take a look at our following beverage company, which is Pepsi. Very similar to Coca-Cola. I've done a video on Pepsi before. I like it because it's kind of hand in hand with Coca-Cola. So Coca-Cola does well, Pepsi does well. They kind of need each other. They're a back and forth seesaw. And we're going to go ahead and see that within their chart. So ticker symbol PEP, PEP. We'll go ahead and look at the last 180 days as well for this stock. Let me just double check on that. Yes, so the last 180 days, we're going to see a great trend. But again, we see this volatility and we're going to see an overall drop off. That's going to be right here. We've seen, let's see what that is. It's about probably 7% drop off in this stock over the past few days. It's not what we want, right? For a blue chip stock to be a buy, we're going to want to see it trending upward. But if we see here the overall 200-day moving average, it was usually above it. It performs above it most of the time. And we see when it dips below, it usually recovers relatively well. These are great buy-in points, right around here, and we're seeing another one right now. This is going for both Coca-Cola and Pepsi. They're performing relatively similarly as we come out of COVID, as we come out of this pandemic. People are starting to go to restaurants more. They're going to see an increase in sales overall. The next company that we're going to talk about is Starbucks. Now, before I move on to Starbucks, I forgot to mention, I want to talk about the dividend payout, right? So the dividend yield for Pepsi is a 2.96% dividend payout with a payout ratio of 74%. So this is fantastic for a dividend return. I do hold a stake in both of these companies because I use them every day. And the next company I'm going to talk to you about, I do not hold a stake in. Now, remember, this is not financial advice. Sorry about that. This is for entertainment purposes only. And this next stock is not my favorite pick, but I wanted to bring it up because if you look at all three of these stocks, you actually get paid out on sequential months. That means that in February, you're going to get Coca-Cola. In January, you're going to get Coca-Cola. In February, you're going to get Starbucks, which is our next. And in March, you're going to get Pepsi. If you hold a position, you're going to be receiving those dividends. So you're actually getting paid out monthly, which means that you have a steady stream of income from these stocks. Now, obviously, with anywhere from 2 to 3% payout, we're going to have a lot of money in our positions. But that's okay. If we're able to bring in enough savings, we're able to dump it into these stocks, they're actually going to pay us back at a pretty good ratio. We're going to see that for Starbucks, they do have room to grow at a target range of at a target price of 108. Their volume is dropping low as well, which means that their overall price has dropped. All of these stocks are performing relatively similarly as we're going through COVID in and out. Starbucks actually took a little bit of a rise due to a lot of people being home and just finding reasons to get out of the house. So what did they do? They went over to Starbucks and then they went home. That's all they could do. That's all they had the ability to do. And that's why we actually saw a little bit of a bubble with Starbucks. And that's why we're going to see a little bit of a trend back down. Their market cap is fantastic. We're in that large cap of 118 billion. That's what I'm looking at with these companies. They're all staples. They all have room to grow and they all pay out that dividend. And better yet, they're things we use every single day, so we're used to them, we're comfortable, and we're going to see them around for a long, long time to come. Even if we see only a couple percent growth each year, we don't need to see that 7 to 20% growth to get a return on our money because we got that 2 to 3 guaranteed when they pay us our dividend. Now, Coca-Cola, Starbucks, Pepsi, they've done a really good job of paying out their dividend because their profit margins are so great. Overall, I think this is a great investment strategy if you want to look into getting into dividends early. Relatively cheap stocks. I know Starbucks, 100, Pepsi, 130, Coca-Cola is really up there, but it is a blue chip stock. You have to remember that with most dividend stocks, it's going to come with a little bit of a hefty price tag. So $100 really isn't that bad. If you enjoyed today's video, please leave a like, comment down below, share the video, but most importantly, subscribe to the channel so you can get more content just like this. Thanks, guys.